Dear investor, as a process, let us track the various cuts of Q3 numbers and see if it is still time for alpha. Follow it up with trying to understand what is working in the market and why, and valuations. We would look at risk in the system and also see if the theme of China plus one is playing out. Topics covered hence would be as under Q3 results, and if it is still time for alpha, is the China plus one theme working? What part of high quality growth spaces are working and why, and valuation support. And lastly, risks that we foresee and how are we trying to mitigate them in the portfolios. So on the first topic, the result season and if it's still time for alpha. Well, philosophically, what we believe is markets follow earnings growth, and hence tracking earnings growth is important. The aggregate earning of the universe tracked by our broking arm exceeded expectations and rose 29% on a year-on-year basis versus much lower expectations. So the beat has been of the order of 10%. Earnings for Nifty jumped 17%, a tad lower than the 22% trend that we have seen. But this is again a beat over the estimates of 11-12%. The earnings growth of the universe was fueled by domestic cyclicals such as BFSI and autos, as well as healthy gains from global cyclicals, metals and oil and gas. BFSI clocked 22% YOY growth, while autos registered a significant growth of 60%. Autos have been having a good run for several quarters now. Metal earnings jumped 74%. OMCs are the biggest provider of growth in the index and broad universe. Their profitability surged 4.5% to 12,000 crores in third quarter 24 from just about 2,500 crores in the same period last year due to strong marketing margins. While overall the numbers were strong, number of companies beating expectations were lower than the number of companies missing expectations. So this is the first quarter we saw that weakness. After the result, the EPS estimates for Nifty remains at 975 for financial 24 and 1150 for financial 25. The broader universe, is expected to exceed the growth numbers for the Nifty, which then leads us to believe that this continues to be the time for alpha. Coming down to the next topic, is China plus one really happening globally, or is it still a wish? Now, we have been talking of China plus one for some time now. The move has gained momentum on various counts. To our understanding, the following factors contributed. One, the disruption in supply chains that occurred during COVID. During COVID, various countries got impacted in various time frames in a staggered manner as COVID spread from one country to the other. However, manufacturing was all concentrated in one country, and that country chose to impose the stringent lockdown measure in the world. This disrupted the global supply chains, and as a learning from the same, the globe now desires to have more manufacturing within a country itself or near to it, or have at least multi-country exposure versus putting all eggs in one basket. So for example, China is incentivizing industry to move back to Japan and to other locations. US is doing the same. Now, the other point is China's economic rise has been very strong and sustained. Over a short period of time, it has become the second largest economy in the world and has learned from the West. It has mastered manufacturing and is increasingly becoming leader in many new technologies. It has started flexing its muscles geopolitically. For example, in the South China Sea against all its neighbors and India and Taiwan in particular. It has been competing versus the US for global influence. This is something the West doesn't like and would, seek to delay acquisition of key technologies where it still has a lead. There are several data points to support this trend taking place. FDI in China has reduced from the US. Research papers jointly written with the Chinese scholars, US and Chinese scholars doing joint research papers have also fallen sharply. In fact, number of flights, direct flights from the US to China have also shown a reduction. This is something the Economist, the magazine, notices. The decoupling move from China suits our interest as it opens up export markets for our products and also provides the government elbow room to provide incentive to or protection to the domestic industry, resulting in a sharp improvement in FDI proposals, bank sanctions for newer projects and other indicators of economic activity on the manufacturing side has shown an improvement. Coming down to valuations, we will do it a tad differently. Markets are at a high and this does increase the focus on valuations. Let us understand what part of high growth, high quality spaces have worked during different time periods in the market, which will help us take a view on what to expect going forward. We have tried to make the discussion as process oriented as possible. Let us focus on the chart where we have divided the long period from 2003 to 23 into three parts. 2003 to 2008, 2008 to 2021 and the period beyond 2021. There are several takeaways. Now, I keep saying this, the more you look at the chart, the more stories pop out of it. The growth in EPS in the 2008 to 2021 period was just about 5% for Nifty, just about 5%, which is half that of the nominal growth of the economy. Mid-cap index delivered close to 4% and small-cap index delivered just about 2.8% in that period. Mid and small cap, where earnings growth is expected to be stronger than large cap on account of size benefits, actually grew slower. Again, coming back to the philosophy which says market prices follow earnings. Over this period, we saw large cap index performance was the best amongst various indices. Generating alpha against the large cap index proved difficult for most managers as earnings growth was not there in the mid and small cap spaces or generally speaking outside of the large cap space. In this period 2008 to 21, the highest quality part of the market, the FMCG index for example, saw strong earnings growth of 12%. This is over 2x the earnings growth of the index, and which meant that, once again going by the philosophy that markets follow the earnings growth, this was the part of the market that delivered relatively stronger performance all through this period. It compounded at 15% for 15 years, while the profit growth was 12%. And at the end, at the exit part, traded at never before valuations. This was a period when the highest quality and the highest growth part of the market was nearly overlapping. In the later part of this period, there were large and successive rate cuts which helped the growth valuation sustain higher. Since the highest quality and highest growth parts were overlapping, like we noticed, one could interpret the move as rate cuts helping the highest quality part of the market, while we believe they actually helped the highest growth part of the market. The period after 21 has seen several changes. The mid and small cap indices are seeing a much stronger earnings growth versus the large cap index. In this manner, the period is more like 2002 to 2008 period rather than the 8 to 21 period. The growth in large cap earnings has been significantly higher than that of the FMCG index growth, as an example of the highest quality part of the market, which, as we noted, started the period with extremely high valuation. Highest quality and highest growth part of the market are no longer the same. market continues to follow earnings growth. This has led to significant underperformance of the highest quality part of the market, as was the case in the 2002 to 2008 period. Mids and small and the themes where growth resided performed strongly. Happily, the companies doing well in the current period seem to have a very sustainable level of debt. Debt was the cause of problems in the post 2008 period, and on this count, the companies which are doing well in the present are very well placed. Now, what have we opted to do in the high quality, high growth space? If we run the DCF process of valuation, highest quality part does get benefited from lower interest rate, but the key beneficiary is the highest growth part of the market, where free cash flows lie further down, and the discount rate reductions really help valuations. In the current period, when the highest growth part is different from the highest quality part, we believe the response rate to any rate cut expected over the next few months could be very different and would favor the highest growth spaces versus other spaces in the marketplace. Hence, given our belief that growth is reviving and would sustain given government policies and reverse globalization tailwinds, we have opted to construct portfolios where the growth quotient has been maximized. Team-based processes fleshed out several long period high growth themes. We have looked at China plus one in this edition. For example, we made sure the quality quotient was high and put a filter of 15% on ROCE so that we search for ideas in the better quality half of the market. Typically, our ROCEs are higher than 25%, but where they are not, there is cash on books, and in a combination of cash on book and free cash generation from business, we believe that most of our businesses would not need to raise equity money over the next several years for up to 25% EPS growth. By investing into them, our clients would get the benefit of non-dilutive EPS growth, which ultimately results in stock price performance. As a process towards delivering sustainable performance, we have tried to include all growth themes in the portfolio so that whichever theme works in the market, something in the portfolio is working for the clients and the investing journey is as smooth as possible. Over and above this, we are running high conviction 20 to 30 stock portfolios with no high concentration to avoid risk associated with concentration. The process to rebalance portfolios and recognize and implement stop losses are also well established. We believe that on account of sustained earnings growth delta over benchmark and favorable PEG ratios, even correcting for premium price to earnings paid and cost of managing money, there is a chance to deliver substantial alpha in this construct. While this is our chosen position at the present, it is if a different construct where quality seems to provide better benefits comes out, we would be flexible to change. When we see the valuation segment wise, this is a more traditional way of seeing it. The large cap valuations continue to seem to be favorable. Mid and small cap valuations are higher than long period average. However, in the past, mid and small caps did not have a sustained period of strong earnings growth, continuity for any significant period of time. Given the disruptive nature of 2008 to 2021, which saw Lehman, taper tantrums, bank loss recognitions, ILFS, and ultimately COVID crisis. Hence, historical takeaways may not hold. In this period of reverse globalization, there is a good chance that the earnings momentum in smaller companies may sustain higher than larger companies, which would imply that the space would continue to hold the promise of longer period outperformance. Coming down to risks, contrary to expectations of strong FPI flows in the new year on reduced US bond yield, the same continues to be elusive. US bond yields have again topped 4.2% and FPIs have been actually sellers. US continues to run a large fiscal deficit, and this would require financing, while US Fed continues to taper as per plan. This could increasingly prove more difficult as we go forward. Moreover, the economy remains robust and unemployment percentage remains low. This can postpone Fed rate cuts, and the pace of cuts can be slower than expectations, and which has a consequent impact on valuations. While continued higher than 4% yield in the US is negative for now, the positive is that the influence of domestic flows on the market would continue to increase. Domestic flows are more focused on the growth themes, which have a stronger presence in the mid and small cap segments, apart of course from seeking deep value spaces. Moreover, they are structural, mostly through SIPs, and this suits our growth style of investing much better versus high volume spiking FPI flows. So on this risk, and if we are looking at outperformance as a key deliverable, I think we are well placed. Second risk, conflicts around the world and impact on India. Well, more part of the world are seeing conflicts which were earlier confined to Russia, Ukraine have spread to Israel, Palestine, and now even the Red Sea area is seeing hostilities. This is endangering supply chains and is disrupting trade, and it could result in inflation spike. To guard against this risk, we are more focused on domestic market focused businesses versus exporters at this juncture. Import substitution as a theme should work out quite well in this scenario. Now, risk of an oil price spike remains, which could stretch our fiscal deficit situation. However, as explained in the November 23 edition, we believe that the low current account deficit that exists, this risk is well within tolerance limits. Third risk is the risk of lower global growth. Well, in the coming year, a slowdown in global growth is a real possibility. A large part of the US post-COVID growth has been supported by large and growing fiscal deficit. Now, post-elections in the US, the government would be expected to attempt a fiscal consolidation, which may hurt growth. Even otherwise, given the very high real interest rates, growth is headwinded. China is trying to provide some impetus to growth, but it has its own problems. Our belief is that lower global growth impact on the Indian economy balances itself. Our services exports are resilient and continue to grow. Our goods trade are just about 18% of GDP, and a percentage drop in global growth, or let me say a change in global growth, impacts potentially our growth by just about 18 bps. This drag on growth is compensated by change in oil prices. A lower growth would mean lower than otherwise oil prices. $10 difference in oil prices impacts our import bill by close to $13 billion and compensates for the impact of global growth. Moreover, our exports are benefiting from China plus one, which can more than compensate for any slowdown. Recent trade deficit data was favorable, and now the expectations are that the current account deficit for financial 24 may be just about 1%. So I think risks just now are handleable, and markets could continue to do what they have been doing, tracking earnings growth. With that, thank you guys. Happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.